Welcome to Fable and Fact. We're diving into one of the hottest topics on the economic scene, how Singapore became an economic powerhouse. Did you know that Singapore faced two major financial crises, the Asian financial crisis in 1997 and the global financial crisis in 2008, but came out almost unscathed? In fact, its economy has been growing steadily for the past 2 decades, which is pretty amazing for a developed country. Singapore's GDP per capita is now higher than Japan's, and it even overtook Hong Kong, which was once a strong competitor. Today, Singapore ranks second in the world in terms of GDP per capita. That's incredible. If you caught our last video, we covered how Lee Kuan Yew, Singapore's founding father, tackled racial tensions, built essential infrastructure, and boosted education. Those were huge moves, but there's more to this story. To really leap ahead of its neighbors, Singapore needed something extra. That's where Lee Kuan Yew's genius plan comes in, attracting foreign investment. That's what we're unpacking today. Right from the start, Lee Kuan Yew knew Singapore's challenges. It's a tiny island with barely any natural resources. To escape poverty and thrive, he doubled down on industry and foreign cash. In 1961, he launched the Economic Development Board, or EDB. Sure, it sounds like it covers all things economy, but its real mission was to kickstart Singapore's industries and reel in foreign investors. Imagine the scene. The whole country buzzing with construction, industrial parks popping up everywhere. They even set up the Singapore Development Bank to pour money into these projects. The EDB didn't mess around. They went full throttle. They wrote letters, dialed up CEOs, and even showed up at the doorstep of Fortune 500 companies, pitching Singapore as the perfect spot. Awesome conditions, low costs, and a giant port. Oh, and the government? They'd have your back 100% if you built a factory there, but words alone don't seal the deal, right? Singapore had to prove it meant business. And what do investors crave most? Yep, tax breaks. So, here's what they did. They started by letting new factories skip taxes entirely. Then, they dropped tariffs to 0. And check this out. Corporate income tax went from over 40% to just 17%. That's a sweet deal. Foreign companies could pocket most of their profits. Plus, personal income taxes got some perks too. Before you knew it, Singapore was the go-to tax haven for businesses and big earners alike. But wait, there's more. They rolled out a one-stop service system to slash red tape. No antitrust headaches, no endless approvals, no license hassles, no currency controls. Just sign up and get started. Today, Singapore's the second easiest place in the world to do business, according to the World Bank, trailing only New Zealand. That's how welcoming they made it. There was a hiccup, though. Back in the early 60s, labor unions were a force, striking all the time. Lee Kuan Yew saw the problem. No foreign company wants daily drama. So, he rolled out policies to dial back union power, ensuring a stable scene for investors. Some folks argue Singapore went too far, maybe even sidelining local businesses to favor foreigners. Fair point, but it worked. Companies poured in. By the late 60s, big multinational players were setting up shop. At first, it was basic stuff: clothing, toys, wood products. Then, in 1968, Texas Instruments showed up, followed by Hewlett-Packard in 1970. That flipped the switch. Singapore's electronics industry took off like a rocket. Thanks to these giants, manufacturing's slice of GDP shot from 10% in 1960 to 25% by 1980. That's a massive leap. The economy was blazing, growing over 10% a year, with unemployment practically non-existent. Even after 2 oil crises in the 70s, Singapore kept its cool. As the country got richer, though, labor costs climbed, squeezing traditional manufacturing. So, they shifted gears. High-tech was the future. Semiconductors, biotech, you name it. They also got savvy with their port. Instead of just moving goods, they added value, refining Middle Eastern oil, assembling electronics, testing chips. It's like the port became a full-service hub, processing and shipping in one smooth flow. That kept manufacturing a powerhouse. All these moves, tax cuts, easy processes, labor calm, not only packed the island with factories, but also made Singapore the world's second busiest port, just behind Shanghai. Most countries guard their local industries with rules, but Singapore? Wide open, policies, banking, everything screamed, "Come on in." Picture nations as neighborhoods, The US and China are the big gated ones, while Singapore's the bustling intersection. Open roads, low fees, and traffic cops keeping it smooth. It's a trade fortress. How big is trade to Singapore? Check its trade to GDP ratio, not just exports minus imports, but the total of both compared to GDP. Say one country exports and imports $1 trillion each, that's $2 trillion in trade. Another does 0. Same net trade, but the first lives on it. The US sits at 27%, China at 38%, solid numbers. Singapore? A mind-blowing 337%. Trade's over 3 times its GDP, and since 1960, it's never dipped below 200%. That's why it's a global hub. Local demand's a side note, trade's the heartbeat. Here's a cool twist. Unlike most places, Singapore doesn't tweak interest rates to steer its economy. It controls the exchange rate directly. If the Singapore dollar weakens too much, the central bank, the Monetary Authority of Singapore, MAS, buys it with foreign reserves. Too strong? They sell. It's all about balance. Most central banks play with rates, but Singapore's all in on currency stability. Why? Central banks focus on price stability, not growth. Rates usually control money flow, like a faucet. Low rates, fast cash, rising prices. But Singapore's a trade junction. It's dollars more for global deals than local shopping. If world prices jump, Singapore feels it, thanks to imports. Adjusting rates works, but it's sluggish. A stronger dollar cuts import costs fast, taming inflation. For a trade titan like this, exchange rate steadiness beats rate games. Let the market sort the rest. A stable dollar also screams reliability to global partners. Who'd invest where the currency's a roller coaster? No one sane. Predictability's gold. Wild swings scare off business, as Japan's recent yen drop showed. Singapore lets its dollar float in a band, not pegged like Hong Kong's, but tightly managed. Think 0.69 to 0.76 against the US dollar recently. Flexible, yet steady. Why don't others copy this? You need serious cash reserves. Weakening your currency? Print and sell. Strengthening it? Buy with dollars or euros you've stockpiled, not printed. Most nations can't swing that. Singapore can, thanks to decades of smart moves. Stability, infrastructure, education, investment, manufacturing, a virtuous cycle. Trade surpluses, selling more than buying, keep the dollars flowing. Companies swap those dollars for Singapore dollars at the MAS, which hoards them. It's earned, not printed. Even better, Singapore's got a current account surplus, more money in than out, beyond just trade. Foreign investment's a huge chunk. In 2022, it hit $141 billion, third globally behind the US and China, for a nation of 6 million. Finance takes over half, but it's a cash magnet. Sure, investors could bolt, like in the '97 Asian crisis, but Singapore's kept them hooked. Why? Low taxes, stable money, easy business, English fluency, top schools, and calm politics. Hong Kong's close, ranking third in business ease, but Singapore edges it out. Big banks love it. 24/7 hubs in New York, London, then Asia, Tokyo, Hong Kong, or Singapore. That cash and trade surplus beef up reserves, letting the MAS flex on currency control and keep investors chill, dodging '97-style crashes. Why not invest that pile? Enter sovereign wealth funds. GIC and Temasek managing $1.2 trillion. No oil money here, just trade smarts. Split it among 5.7 million people, that's $210,000 each. Started local, they've gone global. 70% overseas now. Temasek bowled $400 billion in stocks like Tencent and Visa. GIC's cautious, spreading bets across bonds and real estate. Half their profits fund the government, 20% of its budget. The rest grows the pile. The MAS seeds them, they buy bonds, and cash flows back. Central bank and government? One team here, unlike most places where that'd spell chaos. It works because corruption's near zero, 5th cleanest worldwide. Policies stick, no skimming, high pay, $1.6 million for the PM, and harsh penalties, like caning for crimes. Keep it tight. Caning's brutal. Soaked rattan, 100 miles per hour lashes, permanent scars. Over 1,500 a year face it. Deterrence works. So, Singapore lured factories with openness and cheap labor, then climbed to finance with trade savvy, stability, and talent. GDP soared, government coffers swelled. Open immigration, 100,000 yearly versus 30,000 births, fuels it, though locals feel the heat. Competition, rising costs. It's pricey, top with Zurich, says The Economist. But subsidies ease it for citizens. Still, expats gripe more than locals. That's Singapore's economic tale. Hope you loved it. Correct me in the comments if I missed a beat. Hit like, subscribe, and ring that bell for more. Thanks for watching.